Welcome back to Market on Close. I'm Caroline Woods. Our next guest says his firm's strategy helped protect them from volatility in markets. We're joined by Nigam Arora, founder of the Arora Report. Nigam, thanks so much for joining the show.
Thank you for having me, Caroline.
So I was taking a look at the notes, and you say you have a success story to share amidst the market turbulence in terms of your Arora Report strategic portfolio. Not sure if it'll be an inspiration to those who maybe weren't as lucky, or maybe it will rub some salt in the wounds. But I'm curious about this success story, and what does that look like in terms of returns?
Sure. So in terms of success story, I realized that those who did not follow the strategy, in time, there's hope because markets fluctuate, right? So once you learn these kind of strategies, you can use them next time, right? So this is not the first time market has gone down. So we use a concept called dynamic hedging, which simply means it changes. And we use a very sophisticated model that incorporates the best elements of macro analysis, all international, and then technical analysis, quantitative analysis, and we've got a lot of stuff going on there. It's adaptive, meaning it changes itself with market conditions. So before this big drop that you're seeing, overall, we had 80+% hedges. So, we have not lost money like a lot of people have. And there are four components to it. The first one is overall portfolio level protection, which you can have either cash or inverse ETFs on indexes. If you're having NASDAQ tech stocks, the NASDAQ PSQ, try to avoid, leverage ETFs as much as you can because of the tracking error. Then, at least in our case, and I think in a lot of other investors' cases, there are large positions that have become very large because of large gains, right? So, for example, Nvidia would long from $12.55. Apple would long from $4.68. So not now, but when they were close to the top, we started hedging them. And now, as the market comes down, these stocks come down, those hedges become very profitable. So we start taking some of those hedges, essentially realizing profits. And then the other component of hedging is we have a very large position in gold. We came with a short position in oil. We have a position in Japanese yen. So these are the assets that have done well as stocks have come down. And finally, I know some we are primarily long only investors, but we also short sell, and short positions have been very profitable. So combining those, we were very well protected. And now as the market has come down, we've been taking off those hedges and trying to deploy more cash.
Is that because you think the worst is behind us?
No, I didn't say that. The market has come down enough and all those hedges have become very profitable. So we were 80+% protected. Now we are 40+% protected. So we are kind of half as protected as we used to be. So we're still on defensive.
But half is protective. So do you think that we've at least seen the lows at this point?
Well, so as you know, you do, by the way, I've been watching your show, you do an excellent job. It's news-driven market, right? It's in President Trump's hands to some degree, hands of other foreign leaders. So you really cannot predict which way what's going to go. But I think what I would suggest to investors, in addition to the noise of the news every day, kind of focus on two things. One is the underlying macro environment where the data is leading us. And the highest probability scenario right now is we may see stagflation. So in our model, we have about 70% probability of stagflation, okay? Stagflation is not that great for markets, right? Earnings will come down, PE multiples shrink. And then in terms of day-to-day noise about the news, we were very successful in President Trump's first term. When he was elected, people were not very positive initially, and we were saying, hey, market is going to go to 30,000 in his first term, and that happened. We started saying that when market was 16,000 Dow. And I think what we have learned about President Trump is do not focus on his tweets or his posts and what he says day to day, but try to figure out what is he really trying to do, right? For example, in his first terms, when he was saying, I'm going to build a beautiful wall on Mexican border and have Mexico pay for it. Well, if you thought about it and said what he was trying to do is reduce immigration from the southern border, right? And now when he's talking about trade wars and tariffs, what's he trying to do? He's trying to reduce the trade imbalance and bring a lot of manufacturing to United States. So if you focus on what he's doing, what he really wants to do, not day-to-day tactics, then you can start forming a framework. And President Trump is doing a very good job in describing that we may have a detox. So so all the things he's talking about, they're going to be good for America in the long term, but in the short term, depending upon how various deals turn out, the news of the day is positive, negative, we can swing wildly down or up. And then the macro drop of potential stagflation. So you got to be defensive. There's a pretty good chance we may have already seen the lows, but it's not zero probability that we can't break those lows. We can. Um, so that's why we're still well protected compared to most people, but not as much as we used to be. So now we have a lot of cash because we sold a lot of stuff up there and now we're reducing hedges. So we're applying those. And what I suggest to investors is look at your investing in, kind of put it in two buckets. Strategic positions, which are long positions, right? Like we should say, I'm going to buy this, I'm going to hold on for a long time. And the second is tactical positions, which may hold on for a month or two or six or whatever. And you do want on the tactical positions, close stops and risk controls and position size controls and so on. So right now, I think our strategy is until there's more clarity, with our cash, we're buying tactical positions. A good example is, recently when Nvidia dipped, you know, high 80s to low 90s, we're buying it. And we call that as a trade around position, meaning we have a core position, which was mostly hedged. We've taken a lot of hedges off the core position now. We still have some hedges. And this trade, that's a very long-term position, right? We intend to hold on for several years. But now we have this trade around position, which we picked up taking advantage of the market dip. And now, as Nvidia has risen from those lows, we are taking partial profits. So I think that's the kind of strategy investors need to use. Two buckets, separate out strategic from tactical.
Okay. All right, we're out of time because we're up against the bell, but I hope you'll come back and discuss more specifically about how you're putting that cash to work. Want to get some of your picks. Nigam Arora, founder of the Arora Report. Thank you so much. Hope to talk to you again soon.